Everyone thinks it was a war on hoarders, a patriotic call to stabilize the economy, a bold move by President Franklin D. Roosevelt to save the nation from the depths of the Great Depression. But that's the surface story. The truth is darker and far more mathematical. In April 1933, the United States government issued Executive Order 6102. On paper, it was simple. American citizens were required to turn in all their gold coins, gold bullion, and gold certificates to a Federal Reserve Bank. In exchange, they'd receive paper dollars, $20.67 for every ounce of gold they handed over. That part at least was honest. For now. But the paradox is this. The very institution that demanded the gold, the federal government, had no gold of its own. Not enough, at least. The vaults of the U.S. Treasury were running dry, the dollar was bleeding credibility, and America was quietly, rapidly defaulting on the gold standard. So what looked like a bold rescue mission was actually something else, a confiscation to avoid collapse. They called it economic recovery, but it was really a forced asset swap, trading something real for something printed. Americans didn't lose their gold because of greed or speculation. They lost it because their government couldn't keep a promise it had made in writing, that every paper dollar was backed by gold, that you could redeem it, that gold, in effect, was your insurance policy. Order 6102 shredded that contract, quietly, legally. And once the gold was in federal hands, just months later, they raised the price to $35 an ounce. Overnight, the government increased the paper value of its newly acquired hoard by nearly 70%. The public didn't get that windfall. The banks did. The Treasury did. The Federal Reserve did. You got paper. It wasn't a recovery plan. It was a wealth transfer hidden inside patriotism. And what makes this more than just a historical footnote is this. It proved, once and for all, that money isn't what you think it is. It's not the paper, it's not the coin, it's not even the gold. It's who controls the redemption. You can't understand 1933 until you understand the machine America had been building for decades. A machine powered by gold, debt, and promises that were always just a little bigger than the metal underneath them. Everyone imagines the gold standard as a kind of eternal law, stable, ancient, untouchable. But in reality, it was a political invention, assembled piece by piece, under pressure, by people who needed control more than they needed stability. Go back to 1913, the year the Federal Reserve was born. It wasn't created to fight inflation or guide the economy like the textbooks say. It was created because the banking system kept collapsing under its own leverage. Private banks were issuing credit far beyond the gold in their vaults. They made loans, expanded deposits, financed speculation, all with the assumption that no one would ever show up asking for gold at the same time. In 1907, that assumption shattered. A panic runs on banks, trust evaporated. Gold drained out of the system like water through broken pipes. J.P. Morgan himself had to step in, personally coordinating the rescue. One man stabilizing an entire national system. That terrified Washington. So in 1913, they created the Federal Reserve, a centralized lender of last resort, a manager of gold flows, a guardian of convertibility. But the irony is that the Fed didn't fix the imbalance between paper promises and physical metal. It amplified it. Suddenly, the entire banking sector could expand credit more confidently because now there was a central institution to bail them out when the gold ran thin. What looked like stability was really leverage with better branding. Then came World War I. The U.S. wasn't ready for a global conflict financially, but war doesn't wait for your balance sheet. The government issued bonds, banks bought them, the Fed supported them, money supply ballooned, gold coverage shrank. And after the war, instead of shrinking the system back to its pre-war size, the government let the bubbles float. Wall Street boomed, industry boomed, everyone leveraged the future, assuming gold redemption was a technicality, not a real possibility. But mathematics doesn't negotiate with optimism. By the late 1920s, the U.S. banking system had created more claims on gold than gold itself. For every dollar that promised convertibility, only a fraction existed in vaults. If you've ever wondered how the roaring 1920s went from champagne towers to bread lines in just a few years, this is the key. When the stock market crashed in 1929, the expansion reversed instantly. People wanted cash, banks needed reserves, and those who didn't trust paper wanted gold. The drain began again, not from speculators or foreign enemies, but from ordinary depositors fulfilling the very right the government had promised them, redemption. By early 1933, America was running out of gold fast. Bank after bank failed, states declared bank holidays, governors shut down withdrawals. It wasn't chaos, it was arithmetic. You cannot redeem what does not exist. And here's the quiet part. President Roosevelt did not walk into office with a detailed plan to seize gold. The machine created long before him forced his hand. The Federal Reserve, the Treasury, Wall Street, they had all built a monetary system where the volume of promises would always grow faster than the supply of real metal. The moment confidence cracked, the entire structure threatened to collapse. So the government reached for the only lever left, force. Order 6102 was not a rogue decision. It was the final stage of the system America constructed between 1913 and 1933. A system that relied on gold for trust, but relied on paper for growth. No one intended for it to implode. No one intended to confiscate private savings. But once the numbers were too large to reconcile, politics had to bend to mathematics. Imagine it this way. If a company sells 10 times more tickets than seats, the disaster only appears when the audience shows up. That's what happened in 1933. The audience arrived. They wanted gold. And the government realized it didn't have enough seats. Not even close. So instead of admitting default, they nationalized the chairs. And the irony? They blamed the people for holding the very asset the system had claimed to honor. When you look at it through this lens, 1933 stops being a strange historical footnote. It becomes a predictable outcome of a machine designed to grow, even when the foundation couldn't support it. A machine built by ambition, pressure, and the belief that redemption day would never come. But redemption days always come. For 20 years before the collapse, America lived in a dream built on gold, but floating on paper. And for a while it worked so beautifully that no one questioned it. From the end of World War I through the 1920s, the United States wasn't just rising, it was dominating. Factories roared, skyscrapers rose, banks handed out credit like candy, and Wall Street became the beating heart of global finance. This wasn't accidental, it was engineered. The gold standard, or what people believed was the gold standard, created the illusion of discipline. But behind the curtain, the mechanics had already changed. Let's pause on that word, illusion. You see, gold standards can come in two forms. There's the hard kind, every dollar backed, redeemable on demand. Then there's the managed kind, where redemption exists in theory, but is delayed, rationed, or quietly discouraged. After 1914, most of the world had quietly moved to the second kind. Britain suspended gold convertibility during the war. So did France. Germany printed paper into oblivion. But the US, it held the illusion longer. While Europe burned, America sold them weapons, food, and credit, and received gold in return. By 1920, the US held over 40% of the world's official gold reserves. That gave it power. But it also created temptation. Because here's the trick. When everyone believes their paper dollars can be exchanged for gold, you don't actually need to redeem them. The promise alone is enough. Until it isn't. That's how you get leverage. That's how you grow a system beyond its base. It's the financial equivalent of fractional seats in a theater or selling umbrellas during a drought. And in the 1920s, America built an entire economy on that leverage. Banks multiplied deposits. The Federal Reserve, still barely a decade old, set interest rates to stimulate borrowing. Stockbrokers extended margin loans to retail investors. Businesses took credit to expand factories. Households bought cars and radios on installment. Real estate boomed. Florida became the Las Vegas of the decade. And through it all, gold barely moved. That's not because gold wasn't important. It's because gold had become ceremonial. A symbol of discipline, not the actual limit. Think of it like a speed limit sign on a highway with no cops. Technically, there are rules, but everyone's doing 90. The real fuel wasn't gold. It was trust. Trust that the system would keep expanding, that the Fed would provide liquidity, that the banks wouldn't fail, that redemption wouldn't be necessary. And for a while, everyone got rich. Between 1921 and 1929, the U.S. stock market quadrupled. Industrial production soared. Credit growth exploded. Even the average American began investing. People called it a new era, a phrase that should always make you nervous. Because underneath that boom was a hard truth. The amount of physical gold never matched the claims against it. In 1929, total currency and demand deposits in the U.S. were about $45 billion. Gold reserves? Less than $4 billion. If even 10% of people demanded real metal, the game was over. But no one asked for gold, not when prices were rising. That's the illusion phase. The numbers go up, so people don't look down. They trust the dollar, they trust the bank, they trust the system. And ironically, that trust is what holds the system together until it begins to unwind. Think of a tightrope walker who keeps going higher. Every successful step builds confidence. The crowd cheers. The rope looks secure. But the higher they go, the more deadly a slip becomes. That was America in the late 1920s. No one thought the rope would snap. Not the banks, not the politicians, not the people. They had forgotten that underneath all the paper and credit and leverage, there was supposed to be metal, silent, finite, unforgiving. But gold doesn't cheer. It doesn't inflate. It just waits. The moment someone calls the bluff, everything changes. If you've ever watched a bubble rise and wondered how people didn't see it, now you know. They didn't want to. If this helped you connect how confidence creates illusion, drop a comment and share what country you're in. Let's see how far this illusion traveled. It didn't happen all at once. Systems like this never collapse in a single moment. They unravel, quietly, unevenly, in whispers first, then in shouts. And by the time people realize the truth, the exit doors are already locked. The 1929 crash wasn't just a market correction. It was the beginning of the end of convertibility. Because when the stock market fell, it wasn't just paper wealth that vanished. It was trust. And when trust dies, everyone starts reaching for something real. Gold. Banks began to fail. Not just the weak ones, but the foundations. Over 9,000 banks collapsed between 1930 and 1933. That's not a statistic. That's the oxygen being sucked out of a nation's economy. People rushed to withdraw deposits, not because they were greedy, because they were rational. You don't want to return on your money when you're not sure you'll get a return of your money. And the government? It hesitated. It passed emergency laws and injected liquidity. The Federal Reserve lowered rates. But it didn't stop the bleeding. Because no central banker, no matter how confident, can repeal arithmetic. By early 1933, the U.S. gold reserve, the metal that supposedly backed every dollar in circulation, was vanishing. It dropped to $4.2 billion, while total paper claims in the system hovered over $80 billion. That's like a casino that has chips for every player at the table, but only a few $1,000s in the vault. The moment someone wins big and asks for cash, game over. And then came the real trigger. International redemption. Foreign governments, especially France and Britain, saw the writing on the wall. They didn't want to hold US dollars anymore. They wanted gold. So they began redeeming, legally, through official channels. In other words, America's bluff was being called. Gold flowed out through the front door while domestic depositors banged on the back. That was the moment. The arithmetic couldn't be ignored anymore. March 1933. Roosevelt had just taken office. The country was in chaos. Banks in 38 states were already closed. People were hiding coins, sewing gold certificates into clothes, burying family savings in gardens. It was not hysteria. It was survival. And then the switch flipped. FDR declared a nationwide bank holiday, a euphemism for a complete shutdown. For 7 days, Americans couldn't access their accounts, couldn't withdraw, couldn't redeem. Everything froze. It was the moment the system paused to decide whether it would default or change the rules. And change them it did. On April 5, 1933, Executive Order 6102 was signed. The government didn't use the word confiscation. That would have sparked rebellion. It called it hoarding, a crime, punishable by $10,000 in fines or 10 years in prison. Overnight, private ownership of gold became illegal. But here's the twist. You had to turn in your gold at the official price of $20.67 per ounce. And once the government had it all, they raised the price to $35 just months later, quietly, legally. The math is astonishing. That single change increased the value of the federal gold stockpile from $4 billion to over $7 billion, a 69% increase in the dollar value of their holdings, not through mining or trade, but through decree. They devalued the dollar while holding your gold. This wasn't about recovery. It was a carefully timed transfer of purchasing power from citizens to the state. The banks were recapitalized. The Treasury's balance sheet improved. The Federal Reserve could now expand credit again. And the public? They had paper, redeemable for nothing. The gold clause in contracts was nullified. Private lenders who had demanded repayment in gold got crushed. Life insurance policies denominated in gold? Worthless. Railroad bonds? Devalued. In a stroke of the pen, the government rewrote millions of private contracts and courts upheld it. And still, most people accepted it. Not because they agreed, but because they were exhausted, they were afraid, and because by that point, they no longer believed redemption was possible anyway. That's the most dangerous part of any system collapse, when people start to believe the lie was always true. They told Americans gold wasn't money anymore, that paper was patriotic, that trusting the government meant stability. But underneath, the same arithmetic still ruled. More paper had been promised than metal existed. And once the numbers got too large, the system did not shrink, it rewrote the rules. If you're wondering whether it could happen again, the answer is simple. It never stopped happening. If this shattered what you thought you knew about 1933, share this with someone who still thinks gold is just a relic. They said the same thing right before they took it. After 1933, Americans didn't wake up in a utopia. But the crisis stopped. Banks reopened. Confidence stabilized. Paper dollars became normal again. That's the genius of systems like this. When you reset the rules, people adapt faster than they protest. But here's the uncomfortable truth. What happened in 1933 wasn't the end of gold convertibility. It was the end of your convertibility. The government still had gold. Foreign central banks still had gold. The Federal Reserve still marked gold as the foundation of its balance sheet. But the average American, the worker, the saver, the small business owner, was locked out of the old system. They weren't allowed to redeem the currency they used every day. They weren't allowed to see what backed it. They weren't even allowed to legally own the asset that had served as money for thousands of years. The hierarchy changed. At the top, governments and central banks. Below them, commercial banks and large creditors. At the very bottom, the public. That structure didn't collapse. It solidified. The US dollar became a currency backed by state-controlled gold, not privately redeemable gold. The difference is everything. When redemption disappears, discipline disappears with it. Gold stops being a contract and becomes a decoration. And because the discipline vanished, something predictable happened. The United States expanded its monetary system far faster than its gold reserves. Again. Between 1933 and 1944, the U.S. used this mechanism to rise from a depressed nation to the world's financial sovereign. Gold flowed into American vaults as Europe fought World War II. By 1945, the U.S. held over 70% of the world's official gold. That staggering concentration set the stage for the Bretton Woods system, the next illusion era. Under Bretton Woods, countries pegged their currencies to the dollar, and the dollar was pegged to gold at $35 an ounce. But only foreign central banks could redeem dollars for gold. Not you, not companies, not investors. The public was permanently walled off from the escape hatch. That's the legacy of Order 6102, not the confiscation itself, but the transformation of money into a one-way promise. You could pay the government, but the government no longer had to pay you in anything real. From 1944 to 1971, the U.S. repeated the same pattern as the 1920s. It issued more dollars than it had gold to back them. Wars, foreign bases, credit expansion, corporate leverage, all financed by promises. And just like in the pre-1933 era, foreign institutions eventually noticed. France, under Charles de Gaulle, famously demanded gold in 1965. Britain followed. Others prepared to do the same. The vaults began to drain again. Sound familiar? August 15, 1971. President Nixon ended foreign convertibility. The temporary suspension became permanent. The last link between the dollar and gold snapped. And just like 1933, it was done not through debate, but through urgency. Not through consensus, but through necessity. Because the numbers had outgrown the metal. Again. And what emerged was something new. A purely fiat global system. No gold, no redemption. Nothing backing money except confidence, legal code, and central bank control. But here's the part people miss. Although gold left the system, the logic of 6102 stayed. When governments need liquidity, they change the rules. When debts overwhelm the system, contracts get rewritten. When confidence fails, convertibility ends. And when the public holds the wrong asset at the wrong moment, it's labeled a risk. Look around you. In 2020-2023, trillions were printed without hesitation. Central banks bought corporate bonds, mortgage bonds, sovereign debt. The same mechanism of paper expansion over real reserves was revived. In 2022-2024, nations froze foreign reserves, seized private assets, and redefined what ownership means in a digital financial system. Gold confiscation is rare, but value confiscation, that happens every decade, just in new forms. Inflation that erodes savings is a confiscation. Negative real interest rates are a confiscation. Capital controls are a confiscation. Bank bail-ins, wealth taxes, emergency financial decrees, they are the modern siblings of 6102. Governments learned something in 1933. You don't have to take the gold, you just have to control the rules around what people can exchange, redeem, or own. And now, redemption is gone. Convertibility is gone. The restraints are gone. The mechanism lives on, but without the inconvenient metal that exposed its limits. The same machine that broke in 1933 and 1971 still runs today. The numbers grow, the claims multiply, the real foundation shrinks. And as long as everyone trusts the paper, the illusion holds. Until it doesn't. If this connection between 1933 and the modern financial world hit you, write your city in the comments so we see how far this echo travels. This was never just a story about gold. It was about belief, about control, about the invisible line between what money says it is and what it can be when the math catches up. When the U.S. government seized private gold in 1933, it didn't just default on a promise. It revealed the architecture of modern finance. Money is not gold or paper or digits. It's permission. And permission is granted or revoked by those who control the levers. The system collapsed because it had to. The numbers didn't lie. But instead of admitting failure, they changed the rules. Instead of shrinking the paper to match the gold, they buried the gold and printed more paper. We do this over and over. Assignats in revolutionary France, Reichsmarks in Weimar Germany, Bolivars in Venezuela, British colonial currency boards in India and Africa, American greenbacks during the Civil War. Each time, the cycle repeats. Real value, paper promise, overextension, collapse, rule change. Not because people are evil, not because leaders are stupid, but because systems built on promises will always, eventually, outgrow what they can actually deliver. The problem isn't gold, or fiat, or central banks. The problem is scale without anchor, growth without redemption. And when the gap between reality and promises gets too wide, it's not morality that decides what happens next. It's mathematics. Governments will always choose expansion. Institutions will always protect their balance sheets. And the public, you, me, everyone, will always be the last to know the rules have changed, until it's too late. That's the warning of 1933, not that gold was taken, but that it was taken legally, efficiently, and with public support. And when the next collapse comes, of trust or debt or currency, it won't look like a revolution. It'll look like an emergency measure, a temporary suspension, a patriotic duty. But the effect will be the same. They'll rewrite the rules. And if you're on the wrong side of those rules, your wealth, your options, your freedom to exit the system may vanish overnight. Because the money isn't yours. The rules are. And history doesn't repeat. It just waits. If this changed how you see financial history, say it in the comments. Say it now, because silence has always been the currency of collapse.